Hello everyone. In corporate accounting, we are going to have a quick revision by learning the forfeiture shares, allotment of shares by pro rata, profit created incorporated, employee stock option, buying back the employee stock option, sweat equity, what is amalgamation, what is acquisition of business, and firm underwriting. All these things we are going to have a quick revision with a short, mini short clips. Please pay attention for each thing and take a note of it.
Hi everyone, in this video we are going to see the difference between absorption and reconstruction. First I will start with absorption. Let's take this example. For example, let's say two companies, one big company and another small company. And now what happening is, one company is getting absorbed by another company. For example, small company is getting absorbed by the large company. And the small company will be liquidated and the small company become the part of the big company. The small company loses existence to become the part of the large company. The shareholders in the small company also become will not exist in the small company and they will become a shareholder of the large company. Next, reconstruction. Now we will see about the reconstruction. External reconstruction is very simple. Let's say for example there is a company with a name X. Something bad is wrong with that X company. So the X company will go for external reconstruction. Company will be liquidated. And then a new company is formed with the same shareholders in the old company, and the new company is called Y company. And the new company is formed with the new name. This company will lose its existence and form a new company with the existing share.
Good morning, sir. I am Sri Shilpa. I am here to speak about the topic of amalgamation. Amalgamation is a combination of one or two more companies joining a new entity. During amalgamation, two or more companies willingly come together and cooperate with each other and diversify or expand their business activities. After amalgamation, two or more companies dissolve and lose their individual existence. Hence, they no longer exist anymore. Thus, amalgamation results in formation of new separate company with unique name, logo, etc. A very known example for amalgamation is that Maruti Motors of India and Suzuki Motors of Japan joined together to form a corporation called Maruti Suzuki. Now, let me explain the advantages of amalgamation. The amount of capital can be increased by combining two businesses in amalgamation. The establishment and management cost can be reduced. The benefits of large-scale production can be secured. Research and development facilities are increased. Monopoly market can be achieved. Now, disadvantages of amalgamation. Business combination brings monopoly in the market, which may be harmful for the society. The identity of the old company completes and finishes. Goodwill of the old company will decrease. Management of the company becomes very difficult. Now, features of amalgamations. Two or more existing companies are liquidized. A new company is formed to take over the companies which are liquidating companies. The nature of business of existing companies is very similar. Liquidating companies are called vendor companies and the new companies is called the purchasing companies. Generally, purchase consideration is discharged by the equity issues of the purchasing company. Let's see what is purchase consideration. Purchase consideration is the amount which is paid by the purchasing company for the purchase of the business of the vendor company. In other words, consideration for amalgamation means aggregating the shares of other securities issued in payment in cash or other assets by purchasing the companies of the shareholders of the vendor company. It should not include the amount of liabilities taken over the purchasing company, which will be paid directly by this company. Now let's go to types of amalgamation. According to accounting standard, there are two types of amalgamation. Amalgamation in nature of merger and amalgamation in nature of purchase. 3. In amalgamation in nature of merger, it satisfies certain conditions in nature of merger. All the assets and liabilities of a vendor company become after amalgamation the assets and liabilities of the purchasing company. The shareholders holding not less than 90% of the face value of equity shares of the vendor company becomes equity shareholders of the purchasing company by the virtue of amalgamation. The business of vendor company is intended to be carried after the amalgamation by the purchasing company. The consideration of the amalgamation receivable by those equity shareholders of the vendor company who agreed to become a shareholder of the purchasing company wholly by the issues of equity shares in the purchase company, except that may be paid in respect of the fractional shares. Book value of assets and liabilities of the vendor should be shown in the accounts of the purchasing company. Now let's see amalgamation in the nature of purchase. If anyone or more in amalgamation in the nature of merger conditions are not satisfied in amalgamation, they are considered as amalgamation in nature of purchase. We already saw what is purchase consideration. Now let's see what are the methods to calculate the purchase consideration. There are two methods, lump sum method and net worth method. Now let's see lump sum method. When a transferee of a company agrees to pay a fixed sum of transferor company, it is called lump sum payment, and that lump sum payment of consideration is called lump sum method. Now let's go to the net worth method. It is also known as net assets method. According to this method, the purchase consideration is calculated by calculating the net worth of the asset taken over by the transferee company. That's all about amalgamation. Thank you, sir.
Business, and particularly under the acquisition of business, I am going to talk about or take about accounting treatment. Okay, let's say what is meant by acquisition. Simply, acquisition means when one company purchases most or all of another company's shares to gain control of that company. அக்யூசிஷன்னா ஒரு கம்பெனி அனதர் கம்பெனியோட ஷேர் எல்லா ஷேரையோ அல்லது மோஸ்ட் ஆஃப் தி ஷேரையோ என்ன பண்ணிப்பாங்க, அவங்க பர்ச்சேஸ் பண்ணிப்பாங்க. எதுக்குன்னா டு கன்சாலிடேட் ஆர் மெர்ஜ் வித் தி பேரண்ட் கம்பெனி கூட மெர்ஜ் பண்ணிக்கிறதுக்காண்டிமா. இன் சிம்பிள் டேர்ம்ஸ், த நியூலி ஃபார்ம்டு கம்பெனிஸ் டேக் ஓவர் தி பிஸ்னஸ் ஆஃப் சோல் ட்ரேடர் ஆர் ஃபார்ம் இஸ் நோன் அஸ் அக்யூசிஷன். In this process, the purchase price is known as purchase considerations, and by the company acquires or purchase the business of other company, it is called the purchaser. Simply, the seller concern is referred as vendor. Okay, now the question rises from the acquisition of business. Why partnership concerns converted into limited companies? Yeah, for what purpose? For what reason? Let's see one by one the reasons for conversion. The first one is to eliminate the financial limitations of sole proprietorship and partnership conditions. And second one, to secure financial assistance from different financial institutions. And the third one, to avoid unlimited liability of the owners in respect of the liabilities of the business. And the final one, to enjoy the advantage of perpetual succession and the like. Actually, the conversion requires some accounting procedures. That is, to close the books of accounts of the business which is converted, and to open the books of the new limited company on such taking over. Behind the reasons, the conversion also requires the following accounting procedures. Okay, now I am going to talk about accounting treatment. There are two important headings in the accounting treatment. The accounting problems arising from acquisition will be discussed under these two headings, namely when new set of books are opened and when the same set of books are continued. Let's see what happened when new set of books are opened and when the same set of books are continued. Under the first heading, when an existing business of a sole trader is acquired by the joint stock company, the following factors should be taken into account. The first one is assets taken over by the purchasing company. Then liabilities taken over by the purchasing company. Then determination of purchase considerations. By there are two methods in the determination of purchase consideration, namely net assets methods and net payment method. Under assets taken over by the purchasing company, the purchasing company takes over all the assets of the vendor company, but fictitious assets and miscellaneous expenses are like discount on shares, debentures, preliminary expenses and the like are not taken over by the purchasing company. Under liabilities taken over by the purchasing company, the purchasing company only taken over the external liabilities and the internal liabilities are not taken over by the purchasing company. For example, share capital, reserve fund, undistributed profits, etc. In determination of purchase consideration, the first method is net assets method. In the net asset method, the purchase consideration calculated by simply formula is assets minus liabilities. When we less the liabilities in the assets, then we declare the purchase consideration under the net assets method. Next one is net payment method. Net payment method means defines the purchase consideration is arrived by adding up the various amounts which the purchasing company agrees to pay to the vendor. Simply, the purchase consideration can be paid by the purchasing company in various ways, either in cash or in shares or in debentures. By adding up all these forms, then we get the purchase consideration. Okay, let's see what happens in the second heading when same set of books are continued. Sometimes on conversion of a business into a limited company, no new set of books is opened, that is the first heading, but the books of the old business are to be continued. If the company decides to continue with the same sets of books, then the following steps may be taken. The first one is revaluation of assets and liabilities, closing of assets and liabilities not taken over by the purchasing company, distribution of resources and losses, closing the capital accounts, preparation of revised balance sheet.
Yeah, hello everyone. This is Bhuneshwari. We are going to be see about forfeiture shares. So first we see about their meaning and small example, and their journal entries, and we compare the journal entry to the meaning. Okay. So first the meaning of forfeiture share. So the forfeiture share means the person, the companies give some shares to the shareholders. The shareholders purchase that companies. Once they are purchased, but they didn't paid any shares on the regular basis, then the company give that share became due. That time the company gives some notice to the shareholders, like they didn't sell, like you doesn't paid any shares, then the shares became due. If the shareholders neglect the notice, and he still continued that activities like in that neglections, then the share became forfeited. Okay. For example, if you are buy a car at loan, okay, at installment method, you paid first month installment and second month installment and also third month installment, but you didn't pay the 4-month installment. It's continuously you didn't pay any installment. That time the bank or any companies give some notice. You have to pay the installment. Otherwise, we can retake the car. They give some notice, but you still continuously didn't pay any installment. They get back that car. Okay, so like the example is applicable to in the meaning. They are both are same. Like the forfeitures, the companies also give some notice. If the shareholders continuously neglect, then they take back the shares. Okay. So the journal entry for the forfeiture share is equity share capital account debit to equity share allotment to calls to any call. So first call and second calls account credit to forfeiture shares account. The reason for why we are debit the equity share holder. Basically, the equity shares all comes under the credit side, but in this side we put the equity shares in debit side, because the reason is always we are reissue the forfeiture shares. So that time the profit is going to be come to the companies. Like in that case, we are putting the equity shares in debit side, and we are put share allotments and first and final calls in the credit side, because it's the unpaid amount by the shareholders. Okay, they didn't paid any shares. Basically, the allotment share is the application share is paid by every shareholders. Because the application is one of the first stage. Once they paid, then only they give the allotment shares and first and final call shares. So everyone should pay the application share. So they doesn't make any sense in that. But the allotment and first and call is going to be, sometimes they didn't pay the allotment or the first and final calls. So that's why we are credit that amount. There are the unpaid amount, and we are credit the forfeiture shares. It means they paid amount. Previously what they are paid, that shares is come under the credit side. Okay, so this is the meaning and example, and we are saw about that meaning and the example and the journal entry of the forfeiture. forfeiture share. Next, the reissue of forfeiture share. Once the shares is forfeited, the company is going to be reissue the share to the other persons. That time it going to be credit to the companies, like it's profit to the companies. So that time the journal entries is that time the journal entry for the reissue of forfeiture share is. So if we talk about the reissue shares, the reissue the company if reissue the shares, the amount of the share it can be any price. Okay, like the unpaid forfeiture share is the total shares of that one share is 10 per shares. Okay. But the previous person paid only the 4 shares and others is going to be forfeited. But now they can reissue the shares at also for 8 rupees. Like more than the face value of the unpaid shares. Okay. So they can issue at the premium or the discount, like the convenient of the companies, they can reissue it at a discount or the premium. Okay, so the journal entry of that forfeiture share is first one when the reissues it at pot. Okay, pot means the face full amount. If they reissue at the pot, then the journal entry is bank account debit to equity share account. Okay, bank account debit to equity share account. And the when reissues at a premium, if they are reissue at a premium, then the journal entry for the reissues forfeiture is bank account debit to equity share capital account debit to security premium. Basically, the premium is come under the credit side, that we all know, pretty know that. And another third one, the third journal entry is when reissues is made, loss, if they made some loss, okay, then the journal entry is bank account debit forfeiture share account debit to equity share capital. Okay, so in this presentations we saw about the forfeiture share meaning and the small examples and the journal entries, and we compare the journal entries to the meaning, and also we see about the reissue shares and also its example plus its journal entries. Hope we all understand that. Thank you.
Very warm greetings. The topic I was given is profits prior to incorporation. So what is incorporation? Now before going to incorporation, let's look at what is absorption. So absorption is when a company takes over another company which is an already existing one and has been running. And the company that takes over this existing company can be an existing company or a newly established firm. So when this company or firm takes over or absorbs another one, it is known as absorption. And after this absorption is being done, the new company is to be incorporated. And after incorporating, a certificate of incorporation is given to the company. This is the basics of what we'll be learning in the next few slides. The next topic we'll be seeing now is basis of appropriation of expenses. The company before being incorporated and the period before incorporation is known as pre-incorporation, and after the incorporation is done, it is known as post-incorporation. And there are some expenses that occur both before and after incorporation. And these expenses are to be apportioned accordingly on some basis and logical reasons, which we'll be seeing now. There are 4 types of basis of apportionment, which are time ratio, sales ratio, weighted time ratio, and weighted sales ratio. These 4 are the major types of basis of apportionment of the expenses during incorporation of a new firm. So the first basis of apportionment of expenses is the time ratio. So the time ratio is the ratio of months or days before and after incorporation during the accounting period. Now let's take for an example, a company is acquired, a business is acquired on 1st January 2000, and this company was incorporated on 1st May 2000, and the accounts are closed on 31st December 2000. So the time ratio for this example would be 4:8, which is 1:2. From 1st January 2000 to 1st May 2000, there are exactly 4 months. So the first half of the ratio is 4, and the second half is post incorporation, which is 8 months. So 4:8. Pre-incorporation is to post-incorporation, which is 4:8, which will be simplified to 1:2. And so the time ratio which will be used to appropriate these expenses that have occurred during the incorporation of the firm will be apportioned in the ratio 1:2. The second method of basis of appropriation of expenses would be weighted time ratio, also known as adjusted time ratio. Now during the incorporation, if there were changes made in the number of employees or office accommodations, then these changes are to be given weightage and the time ratio is to be calculated accordingly. The third type of basis of apportionment of expenses is the sales ratio. Now, sales ratio is more of a logical approach to apportionment of the expenses during incorporation. So the ratio is calculated based on the sales or turnover before the incorporation period and after the incorporation period. For example, if the sales or turnover before incorporation is 2 lakhs and the sales after incorporation is 6 lakh, then the sales ratio would be 1:3. And this ratio would be used to further apportion the expenses of the company. Now the last and the fourth type of basis of apportionment of expenses is the weighted sales ratio. Now in case if the sales were not uniform throughout the accounting period, then weightage must be given to the trends observed in that sales. And the sales ratio is adjusted for the change in trend is known as weighted sales ratio. Now the last topic under appropriation of profit would be the treatment of different items based on their nature and which basis will be used for those expenses to be apportioned. The first would be gross profit or loss. Every gross profit or loss of a company is to be apportioned on the basis of sales ratio or weighted sales ratio. And all the variable expenses which vary directly with turnover like commission, discounts, salesman remuneration, advertisement and carriage outwards, etc. are also to be apportioned on the basis of sales or weighted sales ratio. And then the fixed expenses like salaries, rents, rates, taxes, insurances, depreciation, postage, etc. are to be apportioned on the basis of time or weighted or adjusted time ratio. And then all the other expenses relating to the pre-incorporation period are to be allocated in the pre-period alone, such as vendor's salary. And then all the expenses wholly applicable to post-deduction fees, post-incorporation period alone, like director's fees, debenture interest, formation expenses written off, and then preliminary expenses, etc., are allocated to the post incorporation period. And that will be the end of.
Good evening, everyone. Myself is Arza Lakshmi from BCom CA second year. Now I'm going to discuss about profit prior to incorporation. Let's discuss about what is the meaning of profit prior to incorporation. So when a running business is taken over from a data period to its incorporation or commencement of the profit and up to the date of the incorporation or commencement of the incorporation, in case of private company, then this state is known as pre-incorporation profit. So the first step in incorporation is to establish a company. Then after that we have to register for that the company, that is ROC is nothing but a register of companies issued by the company's registration certificate. Then the company come into existence after a issue of a company registration certificate. After we are issuing that company's certificate, the company will come into existence. Sometimes a company earns profit when the founder to the business in the company name it's before incorporation, that is before receiving the registration certificate. So such profit or profits prior to incorporation of a company. So these are the meaning of the profit prior to incorporation. Then the steps involved to determine the profit prior incorporation is, the first step is to we have to prepare a trading account where the only indirect expenses will occur. Then second is to calculate the time ratio and sales ratio. Time ratio is calculated while calculating the months and the years, and sales ratio is calculated the amount which the business has given. Then third step is to prepare a net profit statement, which is nothing but the profit or loss account for the pre and post incorporation periods. Thank you.
Good evening all. I am A. Abdul Khalik. Now I am studying BCom Computer Application second year. My topic is pro rata allotment. Okay. Next, we will go into what is pro rata allotment. Pro rata allotment refers to the allotment of shares in proportion of shares applied for when a company makes pro rata allotment. It adjusts the excess money received at the time of application, firstly towards the allotment and then towards calls. Nothing. First, a pro rata allotment when it will takes place means during oversubscription. Oversubscription does not takes place in a newly established company. If a company is already established or the company already it has a big name, a reputed company only, the oversubscription takes place. When the oversubscription takes place, then only pro rata comes in. Okay, this is pro rata. Okay, we will move on to next slide. Examples for pro rata. There are three examples for pro rata. Partially allotted means that you have been allotted a lesser number of shares than what you have applied for. What is partially allotted means, if a company has issued 2 shares but the company has received only 1 share, that is known as partially allotted. And next, an allotment of shares is when a company issues new shares in exchange for cash or otherwise. Such allotment of new shares increases the company's shares capital. This is nothing but if a company allotted 2 shares and the company receives all the 2 shares at a time is known as full allotment. In the same time, in full allotment, the new share increases the company shares capital. If the new shares, whatever the shares company receives, it will increase the company's share capital. Okay. The next one, we have therefore we have seen about partial allotment and full allotment. When a company has allotted 2 shares or any shares, but the company has not received any shares in return, that means the shares has been rejected. But in pro rata allotment, mostly the shares won't be rejected, but In some cases, the shares can be rejected. These are the examples for pro rata allotment. Okay, we'll move on to next slide. How to calculate a pro rata allotment? It means that all the applications have been allotted or refused allotment on proportion basis. For example, a company issued 60,000 shares, receives applications for 2,40,000 shares and makes pro rata allotment. A company which issues 60,000 shares but it receives 2,40,000 shares, and then applicants have been allotted 25% of the shares applied. The companies, they have allotted 25% and they have applied 25%. In return, they will receive more than 25% of the shares, whichever the shares they have issued. Okay, we'll move on to next slide. Okay, with the purpose of pro rata allotment. In the first slide itself, I have explained about this. The pro rata allotment purpose is for only for oversubscription. When the oversubscription takes place, then pro rata allotment comes in. Pro rata allotment is done in case of oversubscription. Pro rata allotment means allotment of shares on a proportionate basis. We will move on to next. Okay. Next one, what does the company do with pro rata allotment? In the case of oversubscription, it is not possible for the company to allot shares to every applicant in the number that he decides. Here, when a company gets oversubscription, it is not possible that company has to allot all the shares to the every applicant. So whatever the shares the company has, it is not possible to share every to the applicants. So it is quite difficult. So what the company does is some shares they will issue, some shares they won't issue, they will reject it. The company needs to allot the shares in a proper manner. Whatever the process in a company, whatever the process, in pro rata allotment or anything, it must be in a proper manner. It must be done in a proper manner. The company has the following three alternatives: accept some applications in full and reject the others totally, make pro allotment, and adopt a combination of the above two. The company has to accept some applications in full and reject the others and make pro allotment in a proper manner. Okay, we will move on to the next slide. That's all.
Warm welcome to all. Today we are going to see about a purchase consideration. So start with meaning. So what is purchase consideration? In simple, purchase consideration is a price that is paid for acquisition for another company. The price can be paid in the cash, either by share or other assets. The purchase consideration is used to determine the value of assets, liabilities acquired in the purchase. So, methods to calculate the purchase consideration. In the calculation of the purchase consideration, there will be 4 methods: net asset method, net payment method, lump sum method, and the intrinsic value method. So, what is net asset method? Net asset method is nothing but evaluating the purchase consideration is pretty straightforward. The buyer will take the seller's total assets, excluding any fictitious assets, and deduct all the liabilities from the assets to come up with the value. So next, what is a net payment method? So net payment method in the purchase consideration is nothing but net proceeds will look primarily at the value of total consideration or payment the buyer is willing to make the seller. So next, lump sum payment method. So what is lump sum payment method? The lump sum method, as the name suggests, is one payment to acquire the business or asset. The buyer and the seller agree on one lump sum payment to conclude the transaction. Since the parties will not be making any payment using the securities or other assets that may require evaluation, the transaction will be consumed in much faster way without need a formal valuation of the assets and liabilities. So in the lump sum method, the name itself having a lump sum, so the buyer and the seller agree on a one lump sum payment to conclude their transactions. So the last, intrinsic value method. The intrinsic value method is the value of a company stock. This method uses the seller net asset value on a per share basis, derive the intrinsic value. So in the intrinsic value method, seller's net asset value one on a per share basis derived in intrinsic value. So thank you friends.